You ever wonder if there's a way to see an economic storm coming before it actually hits? I mean, what if there was a single chart, one that's kind of hidden in plain sight, that seems to predict the future with, well, pretty unnerving accuracy?
It's one of those questions that feels like it should have a super complicated, secret answer, right? But the truth is, for decades now, many of the world's smartest financial minds have all been watching the exact same thing.
And that's exactly what we're going to do right now. We're going to pull back the curtain on what that signal is, how it really works, and maybe, just maybe, what it's telling us about what's coming next.
So this signal we're talking about, it all comes down to a graph. But, not just any old graph. This one is called the yield curve, and you can basically think of it as the economy's early warning system.
All it really is a snapshot of interest rates across time. It just plots the interest rate or the yield that you'd get from government bonds if you bought one that matures in, say, 3 months versus one that you hold for 10 or even 30 years.
Now, here's where it gets really interesting. The shape of that graph tells a story. And there are really only 3 shapes you need to know about. And believe me, each one sends a very, very different message about where the economy is headed. So, in a healthy, growing economy, the curve slopes upward. We call this normal. And it makes total sense, right? If you're going to lock up your money for a longer period of time, you expect to get paid more for it. It's a sign of confidence. Everything's looking good. But sometimes things get weird. The curve flips and inverts, and all of a sudden you're getting paid more for a short-term bond than a long-term one. Now this is the big red flag. It's so powerful because it reflects what millions of investors are doing with their money. They're basically so worried about the economy in the near future that they're piling into long-term bonds even for a lower return just to be safe. And get this inversion has shown up before nearly every single US recession for the last 50 years. Okay, so you're probably asking, how on earth does a graph just flip upside down? Well, to understand why the curve inverts, we need to look at the massive forces that are always steering our economy.
Think of it like this. You've got 2 main levers being pulled. On one side, there's fiscal policy. That's the government, with its tools like taxes and spending. And on the other, you've got monetary policy. That's the central bank, like the Federal Reserve, and their master tool is interest rates.
Central banks are in this constant, high-stakes tug-of-war with inflation. When prices are shooting up, what do? They raise interest rates. That makes it more expensive for everyone to borrow money, which is supposed to cool down spending and get inflation under control. But there's a huge risk. If they pull on that lever too hard, they can tip the whole economy right into a recession.
Now, here's a detail that might surprise you. Central banks don't actually want zero inflation. Nope, they actually aim for about 2 to 3%. And you might be wondering why. Well, a little bit of inflation actually nudges people and businesses to spend or invest their money instead of just letting it sit there and slowly lose its value. And it's that spending and investing that keeps the economic engine running.
So we know these signals are powerful predictors. We know what they mean. But what happens when a major multi-billion-dollar financial institution just completely ignores them? Well, let's take a look at the recent collapse of Silicon Valley Bank. Man, this quote just says it all, doesn't it? SVB basically went all in on a massive bet that interest rates were going to stay low. This wasn't just a small oversight. It was a truly colossal failure to read the room, economically speaking, and the consequences were huge. So here's the deal. This is what happened. When interest rates were practically at zero, SVB bought up a ton of long-term government bonds. It was a bet that rates would stay low for a long time. But then, to fight off inflation, the central bank started hiking rates faster than almost anyone expected. And the value of all those old, low-rate bonds? It fell off a cliff. They got caught on the completely wrong side of one of the biggest interest rate shifts in modern history. Every single business has a basic playbook for handling risk. You can accept it, you can avoid it, reduce it, transfer it, or you can hedge against it. The collapse of SVB wasn't just some bout of bad luck. It was a complete and total breakdown in applying this basic playbook to the single biggest financial risk any bank faces: interest rates going haywire.
Okay, so we've been talking a lot about banks, bonds, big economic levers, but what does any of this really have to do with you? Well, everything, because these powerful forces don't just stay on Wall Street. They directly impact the interest rate on your mortgage, the money you earn in your savings account, and even the health of the company you work for.
So let's boil this all down. What should you take away from this? First, just think of the yield curve as an economic weather forecast. If it inverts, there are probably storm clouds on the horizon. Second, always remember that central banks are walking a tightrope, trying to balance growth with fighting inflation. And honestly, understanding just those two things is the key to making sense of all the financial headlines you see every day. It's the difference between being confused by the news and actually understanding the forces that are shaping your world.
So, we've unpacked the signal, we've looked at the mechanics behind it, and we've seen the very real consequences of ignoring it. The only step left is to apply it. So I'll leave you with this question to chew on. Now that you know how to read the signs, what do you think the economy is telling us right now?